Brad Williams, Frugal Finance, Equity Risk Premium. The risk premiums is definitely an important input in all the asset pricing models. In the next section, we will start by investigating the supporting determinants of risk premiums, and then look at a number of useful methods to estimating these premiums. What is the risk premium supposed to measure? The risk premium in the CAPM measures the extra return that would be required by investors for moving their money from a riskless investment to the market portfolio or risky investment on average. It should be a function of two variables: risk aversion of investors. As investors become more risk averse, they should insist on a larger premium for changing from the riskless asset. Although a few of the risk aversions may be clear, some of it is also a function of economic prosperity. When the economy is doing great, investors are likely to be more enthusiastic about taking on more risk, and recent events in the market. Risk premiums tend to surge after large market drops. Riskiness of the average risk investment. As the riskiness of the average risk investment rises, so should the premium. This will depend on what companies are actually traded in the market, their economic fundamentals, and how involved they are in dealing with risk. Because each investor in a market is certain to have a different opinion of normal equity risk premiums, the premiums will be a weighted average of these individual premiums, where the weights will be gauged on the capital the investor brings to the market. But more directly, with Warren Buffett, with his sizable wealth, believes is a suitable premium, will be biased more into market prices than what you or I might think about the same measure. Implied equity premiums. This is a substitute to projecting risk premiums that does not need past statistics or changes for country risk, but does assume that the overall stock market is accurately priced. Think about, for example, a very straightforward valuation model for stocks. Value is equal expected dividends next period divided by required return on equity minus expected growth rate in dividends. This is the present value of dividends growing at a stable rate. 3 of the 4 factors in this example can be obtained easily: the current level of the stock, i.e. the value, the estimated dividends next period, and the forecasted 3-year growth rate in earnings and dividends. The one unknown is then the required return on equity. When we solve for it, we get an implied expected return on stocks. Subtracting out the risk-free rate will produce an implied equity risk premium. To demonstrate, suppose that the current level of the S&P index is 4,400. The expected dividend yield on the index for the next period is 2.4%, and the expected growth rate in earnings and dividends in the long run is 3.5%. Solving for the required return on equity yields equals 4,400 times 0.0. Solving for R equals 5.9%. If the current risk-free rate is 1.29%, this will yield a premium of 4.61%. This calculation can be simplified to allow for high growth for a period and widened to deal with cash flows based rather than dividend-based models. To explain this, look at the S&P 500 index on January 1st, 2020. On December 31st, 2019, the S&P 500 closed at 3140, and the dividend yield on the index was roughly 4.56%. In addition, the universal estimate of growth in earnings for companies in the index was about 9.7% for the next 5 years. Since the companies in the index have bought back enormous amounts of their own stock over the last few years, we included buybacks as part of the cash flows to equity investors. Worksheet 5.6 shows dividends and stock buybacks on the index going back to 2014. Year, market index, dividends, buybacks, cost of equity, cash to equity, dividend yield, buyback, and gross yield. In 2020, for instance, companies collectively returned 3.16 of the index in the form of dividends, 1.52, and stock buybacks, 1.64% of that 3.16 payout. Buybacks are volatile and dropped about 40% in the last year of 2020 relative to the last quarter of 2019 in the face of market crisis and slowing economy. Since this slowdown is likely to continue into 2021, we reduced the buybacks in 2021 by 16%. Compute a normalized cash yield of 1.38% for the year, resulting in a total cash to equity of 116.17 for the year. In worksheet 2.7, we estimate the cash flows to investors in the S&P 500 index from 2014 to 2021 by growing the normalized cash flow at 4% a year, first 5 years, and 1.25% thereafter. Here we have our information. Using these cash flows to compute the expected return on stocks, we get the following. Solving for the required return in the implied premium with the higher cash flows, required return on equity is 5.678. Implied equity risk premium is equal to 5.678 minus 1.25%, that's the risk-free rate, equals 4.428%. For the most recent implied equity risk premiums, visit the Motor Insight. We think that this estimate of risk premium, 4.428%, is a more realistic value for July 1, 2021 than the historical risk premium of 5.5%. What makes this approach better is that it is market-driven and forward-looking and does not need historical data. Also, it will adjust in response to changes in the market movements. Note that the S&P 500 a year prior was trading at 3,100 and the implied equity risk premium on July 1st, 2020 was 4.72. The unusual movements are best viewed by graphing out implied premiums from the S&P from 1960. You can see it's a volatile little beast, but very, very, very favorable in terms of forward-looking analysis. In terms of mechanics, we projected growth rates using analyst estimates of dividends and earnings growth and two-stage dividend discount model, which is comparable to the one we used to calculate the implied premium in the previous paragraph. Based on these figures, we would infer the following. Implied versus historical risk premiums. For much of the last 40 years, the implied equity premiums has been lower than the historical risk premium, reflecting the long-term upward movement in stock prices between 1981 and 2021. At the peak of dot-com boom at the end of 1999, the implied equity risk premium was 2%, while the historical risk premium was about 6.5%. It is only in the last quarter of 2008 that implied premiums surged well above historical risk premiums. Effects of inflation, the implied equity risk premium did increase during the 70s as inflation skyrocketed. This poses some interesting questions about the movement of risk premiums. Instead of presuming that the risk premium is a constant and is unaffected by the level of inflation and interest rates, which is what we do with historical risk premiums, it may be more practical to increase the risk premium as expected inflation and interest rates increase. Mean reversion, while implied equity risk premiums have changed notably over time with a low of 2% in 1999 and a high of 6.69 at the end of 2018, there is support that they drift back to a historical average between 4 and 4.5%. That turnaround, however, happens over long time periods. Brad Williams, Frugal Finance. Thanks for watching.